How's it going? I'm Jason. I'm your host. Welcome to the Week in YouTube Finance.
For the first time in history, Moody's has officially downgraded the United States credit rating from AAA down to AA1. This is not a drill. This is a major moment in financial history, and today I'm going to break down exactly what this means for your portfolio, your money, and the markets moving forward. Let's dive in. But before that, you're probably wondering, Marco, why are you wearing this outfit? It's because I want to support our struggling American companies overseas. How are these Vietnamese children gluing your Nike shoes together going to eat their bowl of ramen if we don't put them in these factories? Let's get into it. Okay, so this isn't the first time the U.S. has actually seen a downgrade. So back in 2011, S&P dropped our credit rating from AAA to AA+, and the markets didn't take that lightly. Before I show you that, I want to actually explain this chart right here. So the ratings agency is up here. You can see dark blue is Moody's, pink or purple is S&P, and then the aqua blue is Fitch. So you can see the first time in 2011, S&P dropped that right here. The second time was Fitch. That was in 2023. And then the third time, for the first time in history by Moody's, was just a couple days ago. So if we go into the aftermath, let's see what happened here. So after the 2011 drop, after S&P downgraded us, the S&P 500 fell nearly 8% in just 2 months. So the S&P 500 is the blue, the greenish line right here. I know it's kind of hard to tell, but you can see right after that, it just bounced right back. So I don't want this to sound alarmist. You can see the 10-year Treasury yield fell by 35%. That's the pinkish salmonish line. It did spike back up, but also started to keep falling pretty precipitously in the months after. And then if we fast forward to 2023, when Fitch downgraded us, you can see that they cited like ballooning debt, fiscal inaction, Fed rate hikes. I don't know if you guys remember this time. This was only about a year and a half ago, 2 years ago now. The S&P 500 dropped 10%. So the S&P 500 is this green line right here. But then again, it just bounced right back after a couple months. So what I'm trying to get at is you may see a dip for the next month or so. And then after that, up and to the right, baby. Dollar cost average, buy the dip. Don't be a coward. Okay, so if you look at this, the Russell also got smoked. It was down 17%. And unlike 2011, yields actually surged 23% instead of dropping. So bottom line, pay attention to your debt, be cautious with new borrowing, and as always, stay diversified, stay disciplined. If you got value from this video, don't forget to smash, destroy. Gently click the like button, gently click subscribe, gently hit the bell for notifications, turn on notifications on your mobile device so you know when I actually post, and always share the video with 13,000 friends. Thank you so much.
Everyone says if you want to become wealthy, don't drink at Starbucks, don't rent where you live, and work to get a high-paying salary. But there are some very simple wealth killers that most people are overlooking that are holding so many people back from ever becoming wealthy. That's why in this video, I want to go over the 7 biggest wealth killers that I'm seeing right now in today's economy. And wealth killer number 1 is your car insurance. Over the last year plus, the place where we saw the highest inflation is not rent prices, it's not egg prices, it's car insurance. And the thing about insurance is that some insurance companies are going to charge you a whole lot more for the exact same coverage. I'm going to sound like a Geico commercial, but if you spend 15 minutes shopping around for car insurance, you can save 15% or more every single month. Wealth killer number 2 is not earning interest on your savings. Right now, the inflation rate has fallen, while interest rates are still high. According to the last inflation report, our current inflation rate is 2.3%. This doesn't mean that the prices of things have fallen or that we're going back to 2019 prices. It means that the prices of things today on average are growing by 2.3%, which means if you can grow your savings by more than this, you are becoming wealthier. And right now, interest rates are still high because the Federal Reserve Bank has not cut interest rates, which means if you put your money into a high-yield savings account today, you can earn somewhere between 4 to 4.5% in interest on your savings. These are FDIC insured banks. It's not a stock, it's not an investment, it's just a savings account that's paying you a higher rate of interest, which means you can actually get a return on your savings. This is a very different economy than a few years ago, because a few years ago we had inflation rates at, let's say, 5 to 9%, while savings accounts were paying you 2 to 4%. So take advantage of these higher interest rates, that way you can actually beat inflation. That being said, saving your money even at a high yield savings account is not going to make you wealthy. You have to invest your money, which brings me to wealth killer number 3, being an emotional investor. Let's do a little history lesson on the 2025 stock market, because in February, tariffs were announced, causing the stock market to crash. Then, one day later, when the tariffs were paused, we saw the stock market boom again. In March, the tariffs were reinstated, causing a global stock market sell-off. A few days later, tariffs were put on pause again, and the markets boomed again. In April, we saw Liberation Day, tariffs on countries from around the world causing a global stock market crash lasting about a week. And then those same tariffs were put on pause again, causing the stock market to boom. You can learn from somebody or something else to shortcut your path by spending some money instead of having to do it all yourself. And there you have it, the 7 biggest wealth killers of today's economy. If you have $100 in your bank account and you want to buy this $1,000 Gucci scarf, your bank would love to lend you the $900 at 25% APR, because when you make the minimum monthly payments, your banker gets richer. But that's just the beginning. When it's time for you to buy a house, who do you ask? How big of a house should I buy? Many times it's your banker, and they're not your financial.
What's up, you guys? It's Graham here. So this is getting out of control. As of right now, the national debt is approaching $37 trillion. It's expected to increase by another $1 trillion every 3 months. And with interest payments recently hitting an all-time high, like it or not, there will be serious consequences for everybody watching if you aren't prepared for what's about to happen. For instance, in just the last week, we've seen investors literally selling America. Interest rates have been surging higher. Bitcoin hit an all-time high as investors left the dollar, and the entire financial system was recently downgraded, which is something we haven't seen since the great financial crisis. This is why we really have to talk about exactly what's happening, what this means for you, why the billionaire Ray Dalio says that the risks are greater than they appear, and then what you could realistically do about this to come out ahead profitable, especially since right now is the best time to make the most of it, or at least potentially save yourself a lot of money. Although before we start, if you appreciate videos like this and find them helpful, it would mean the world to me if you hit the like button or subscribed if you haven't done that already. I know I don't like asking for it either, it's annoying, but it does make a significant difference for the channel, and as a thank you for doing that, here's a picture of a hamster. So thanks so much, and also a big thank you to Cookie Unity for sponsoring this video, but more on that later. Alright, now in terms of where we start, it all begins right here with the national debt. Think of this like, how much does a country have to constantly borrow to keep itself afloat? And as the billionaire Ray Dalio suggests, this number is growing more and more unsustainable by the day, leading to it's also probably better that you stay at a margin or leverage. I think it's pretty safe to say that you're playing with fire anytime you borrow money for the sake of investing. It's probably not a good idea unless you really know what you're doing or just have an appetite for a lot of risk. And finally, 6, if you need the money for a specific purpose over the next 2 to 5 years, it's probably a good idea not to invest all of it. The reality is, a few years is not a long enough time frame to ensure that you're actually going to make money in the markets. And as we've seen throughout history, there have sometimes been decades where the market has not recovered and you would have lost money in the short term. So the longer your time horizon is, the more likely you are to actually make a profit. Honestly, I don't think our current path is sustainable in terms of national debt and spending, but at least following this should give you the best chances of coming out ahead profitable in the long run. And of course, I'm open to hearing your comments as well, so feel free, let me know your thoughts down below, and I do my best to read and reply to as many of you as I can. So thanks so much, I really appreciate it. Make sure to like and subscribe if you haven't done that already. I really appreciate it, and until next time.
Well, thanks everybody. So here I am. I made it to episode 20. This is supposed to be going to 100. That's the challenge. We'll see how far I make it with your help. How can you help? Subscribe. That at least tells the YouTubes, tell the algorithms, tell the gods and universes and everyone involved that I'm trying. I'm trying to do well. So back me up if you can. Thank you. Weird, right?